Hello, savvy investors, and welcome back to Investor Insights. This is the second video in our trading series. And if you missed the last one, don't worry, just scroll down and watch, but maybe after this video. In our previous video, we discussed what candlesticks are, why they're relevant, and how they should be used. But hey, today's the day we kick it up a notch. I'll tell you about the types of candlesticks. So now, my friends, it's time to take it to the next level. So grab some popcorn, hit that subscribe button, and let's get started. In our recent videos, we discussed OHLC, which stands for Open, High, Low, and Close. We illustrated this with a simple story example, delving into the body and wick of a candlestick. We also explored three types of candlesticks, using the analogy of a house. Think of individual candlesticks as bricks, candlestick patterns as walls, and chart patterns as the entire house. Now it's time to uncover these gems. So let's get ready to build a house of knowledge, or at least become excellent candlestick detectives. Individual candlesticks. When I mention individual candlesticks, I'm referring to single candlestick patterns. In our previous video, we explored patterns such as engulfing, also known as marubozu, hammer, and doji. All these patterns are part of a single category, double candlestick patterns. The first is bullish and bearish engulfing, which we already know. Secondly, there are tweezers. The tweezer patterns are unique and compelling double candlestick formations the trader should keep an eye on due to their potential predictive power. These patterns, both at the top and bottom, can act as vital harbingers, signaling impending reversals in the market trend. Tweezers top. This pattern typically emerges after sustained bullish activity or uptrend. The formation consists of two candles. The first candle in this setup will have a large body, moving upwards and signifying strong buying momentum. This candle often ends with a long upward shadow or wick. This indicates that while the bulls tried to push prices even higher, they met some resistance. The following day or trading period paints a different picture. The market opens near the previous day's high, but reverses direction. The second candle, which is often of a contrasting color to the first, moves downward, suggesting that the bears are fighting back. This counter move by the bears, especially if it engulfs a significant portion of the first candle, signals a potential shift in momentum. This hint indicates an impending bearish reversal. Tweezer's bottom. As the mirror image of the tweezer's top, the tweezer's bottom emerges after a dominant bearish phase or downtrend. The formation kicks off with a candle that highlights seller dominance, moving downward and often ending with an extended downward shadow. This shadow implies that sellers try to depress prices further, but encounter some resistance from buyers. The subsequent candle starts near the previous day's low, but ascends upwards. The first candle, often a different color than the preceding one, signals that the bulls are rallying and countering the bears. If this bullish candle recovers a significant part of the preceding day bearish candle, it's a strong indicator that buying momentum is growing. This suggests a possible market reversal in the near future. Thirdly, there are piercing line and dark cloud cover. Both these patterns play critical roles in the candlestick charting, serving as reliable harbingers of potential reversals. Their formation and significance are deeply rooted in the physiological battle between bulls and bears in the market. Piercing line, often appearing after a prolonged downtrend. The piercing line is a beacon of hope for those bullish on a particular asset. This pattern begins with a long red candle, which testifies to bearish sentiment. Sellers are in control, and the market reflects their dominance. However, the next trading session offers a twist. The day starts with pessimism, as evidenced by the opening price below the previous day's close. But as the day progresses, buyers find their footing, pushing the price up. The resulting green candle not only recovers much of the previous day's losses, but also closes above the midpoint of the prior red candle. This significant recovery underscores a shift in market sentiment. The once downtrodden bulls are now rallying, suggesting the onset of a potential bullish phase or reversal from the prior downtrend. Dark cloud cover. The antithesis of the piercing line, the dark cloud cover is a cautionary tale for bulls. It emerges after a strong uptrend, where optimism reigns supreme. The pattern's inception is marked by a robust green candle, highlighting bullish momentum. As a result, there are clouds of doubt the following trading day. The market opens with even more bullish enthusiasm, with the price above the previous day's high. But this optimism is short-lived. Sellers step in, and the price starts to fall. At the close of the session, the red candle that forms not only erases much of the gains from the preceding day, but also closes below its midpoint. This abrupt shift in sentiment signals that bears might be gaining an upper hand. This warns of a possible bearish reversal or dampening of earlier bullish enthusiasm. So the bullish and bearish engulfing patterns, the tweezers patterns, and the piercing line and dark cloud cover are quite similar. It is critical to note, however, that they are all distinct types, even though they appear to be mirrored. Trading requires observing every minor detail before trading. Therefore, studying these patterns in detail is imperative. In other words, don't miss a detail or you might end up trading in the wrong direction. Triple candlestick patterns. These patterns are highly regarded in technical analysis due to the extended insight they offer over a 3-period sequence. This provides a more in-depth look at market sentiment and potential trend shifts. Here we explore some of the most common triple candlestick patterns. The first are morning and evening stars. Morning star. This pattern offers hope for traders in a downtrend market and suggests a strong bullish reversal. It manifests as a large red candlestick followed by a smaller bodied candle, often a doji, representing indecision, that gaps below the red candlestick. The third candle is marked by a robust green candle that gaps up and closes above the red body candle, confirming the reversal. The full pattern depicts a struggle between bears and bulls, with the bulls ultimately seizing control. Evening star. Serving as the mirror image of the morning star, the evening star warns of bearish reversal following an uptrend. It starts with a strong green candlestick, followed by a doji candle that gaps up, reflecting uncertainty. Third candle presents a red candle that gaps down and closes below the green body candle, representing bears overtaking the bulls. Second, 3 white soldiers and 3 black crows. 3 white soldiers. This pattern is a strong bullish indicator that occurs over 3 candles. It consists of 3 long green candles, each closing progressively higher and with small or no lower wick. This suggests a strong shift in buying sentiment. It's considered a reliable sign of the bull's sheer determination to drive prices higher, often following a downtrend or consolidation. 3 black crows. In stark contrast to the 3 white soldiers pattern, the 3 black crows pattern is a definitive bearish signal. It materializes as 3 consecutive long red candles, each with a lower close than the previous candle, predominantly with small or non-existent upper wicks. This pattern illustrates the aggressive nature of sellers and their success in driving prices down, typically at the end of an uptrend. Third are 3 inside up and 3 inside down. 3 inside up. This is a bullish reversal pattern that surfaces at the end of a downtrend. The sequence begins with a long red candle, indicative of strong selling pressure. It is followed by a smaller green candle that forms within the range of the red candle's body. This suggests a potential shift in trader sentiment. The pattern is confirmed by a third green candle, higher than the second, showing renewed buyer confidence and a likely reversal of fortunes. 3 inside down. Conversely, the 3 inside down is a harbinger of a bearish reversal following an uptrend. It mirrors the 3 inside up structure, starting with a large green candle, then a smaller red candle within the previous candle's range, it ending with a third red candle reaching lower than the second. This pattern signals that sellers are regaining control and a downward trend could be imminent. Now you might ask, what is the difference between the 3 white soldiers and 3 black crows pattern and the 3 inside up and 3 inside down pattern? So to summarize, the 3 white soldiers and 3 black crows signify strong bullish and bearish momentum, respectively, through identical candle movements in their trend direction, while the 3 inside up and 3 inside down patterns indicate trend reversals initiated by contrasting candle within the first candle's range, followed by confirmation in the third candle. Now let's talk about chart patterns. They are like the entire structure of candlesticks, and there are many types of chart patterns. The first one is continuation patterns. Continuation patterns are crucial concepts in technical analysis, indicating that current market trends are likely to continue even after the pattern has occurred. These patterns are often identified during periods when the market shows some pause in its current trend, which can often be mistaken for a reversal. However, through careful analysis, traders can determine that the movement is simply a consolidation before the trend resumes its course. Here's a more in-depth look at several continuation patterns. Number 1, flags. Flags are short-term patterns that denote a small consolidation before the original trend resumes. They appear as small rectangles tilted against the prevailing trend, like a flag on a pole flying at half-mast in a calm breeze. Although flags are short-lived, they are significant indicators of potential continuation of the prevailing trend. The volume usually swells during the flag formation, with a significant spike during the breakout, affirming the pattern's validity. 2, pennants. Pennants are closely related to flags and share many similarities but are typically smaller. They form after strong price movement and represent a brief period of range-bound trading or consolidation. Pennants resemble small symmetrical triangles where prices converge. The breakout from a pennant accompanied by increased volume usually signals that the strong move that preceded the pennant's formation is set to continue. Triangles. Triangles are common occurrences in the market, signaling a period of consolidation and the potential continuation of a preceding trend. They are key patterns that traders monitor to predict the market's next significant move. There are several types of triangle, each with unique implications. A. Ascending triangles. These are potentially bullish patterns in a market where optimism is building, formed by a flat or horizontal line representing an area of resistance and an upward sloping trend line indicating higher lows being formed in the market. This pattern suggests a battle between buyers and sellers, with buyers gradually gaining an edge. The pressure builds with each attempt to break out, leading to upward momentum following a bullish breakout. B. Descending triangles. These are bearish counterparts of ascending triangles, where market sentiment turns increasingly pessimistic. The pattern showcases a level of support below with a downtrend line formed above, reflecting lower highs in the market. It indicates that sellers are more aggressive than buyers, creating downward pressure and the possibility of a market breakdown below support. C. Symmetrical triangles. These are patterns where the market is indecisive about its direction. They are formed by two converging trend lines with a similar slope, one upward and the other downward. This indicates a market with lower highs and higher lows. This formation suggests balance between buyers and sellers, with a breakout from the pattern signaling a continuation of the prior trend. However, the direction is not implied by the pattern itself and must be confirmed by the actual breakout. Rectangles. A rectangle represents a wait-and-see period in the market, when prices move within a bound range. This pattern is characterized by almost equal levels of supply and demand. The price experiences resistance and support at the parallel lines forming the rectangle's upper and lower boundaries, respectively. Traders anticipate the price eventually breaking out of this range, continuing the prior trend. The rectangle serves as a battleground for price consolidation, with the breakout indicating which group, buyers or sellers, gain the upper hand. It's a phase of reflection in the market, determining whether the prevailing trend has enough momentum to sustain itself. So we've discussed continuation chart patterns today. Please note that there are also reversal chart patterns, which I don't plan on discussing in this video. I understand it's a lot to digest. The same is true for valuable books and knowledge that cannot be absorbed in a single reading. To truly understand a book, you may need to read it multiple times. Similarly, I'll recommend watching this video more than once to fully absorb its content. But don't worry, I'm not expecting you to watch it 100 times. That would be a bit excessive. In summary, today we discussed double candlestick patterns such as tweezers, piercing line, and dark cloud cover. We also delved into triple candlestick patterns like morning and evening stars, 3 white soldiers and 3 black crows, and 3 inside up and 3 inside down. Additionally, we covered triangles, including ascending, descending, and symmetrical, as well as rectangles. In our next video, we'll discuss reverse chart patterns and more. So don't forget to tune in next time, when we'll be exploring the mysterious world of reversal chart patterns and uncovering the secrets of the trading universe. Thank you so much for joining us today. I hope you now feel more confident and informed about the stock market. Stay curious and keep learning.